Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta. Joining me today are Paul Galloway, Senior Director, Advisory Services as Strategic Treasurer, and Ben Poole, Writer at CTMfile. Welcome back, Paul and Ben.
Thank you, Push.
Yeah, thanks for having us back, Push.
In today's edition of the Open Treasury podcast, we will discuss four topics, namely a debt crisis that may be on the horizon with US national debt piling up and surpassing $33 trillion. Lack of visibility remains the biggest challenge in managing foreign exchange risk. Basel Committee reports on 2023 banking turmoil and is pursuing a series of follow-up initiatives. And finally, virtual card transactions growing at a significant 388% thanks to API platforms. Our audience can read articles, interviews, and industry roundups by visiting CTMfile.com or by following the links in our show notes. Let's commence today's discussion with the first story, which is about a debt crisis on the horizon with US national debt surpassing $33 trillion. America has the highest level of government debt in the world. National debt is defined as the total amount of outstanding borrowing by the US federal government accumulated over the nation's history, according to the US Department of the Treasury. In essence, this debt is the amount of money borrowed by the US federal government to pay for or cover its operating expenses. As per the US Treasury Department, the national debt has experienced significant surges in recent years, primarily driven by notable events such as the Afghanistan and Iraq wars, the 2008 Great Recession, and the COVID-19 pandemic. The ballooning US national debt is a stark reminder of the country's precarious financial path and is likely to spark a debt crisis, warned billionaire investor and the founder of the world's largest hedge fund, Bridgewater Associates' Ray Dalio, a couple of weeks ago in an interview with CNBC. Dalio also cautioned that high debt levels could spark a balance sheet recession where growth stops because companies and people prioritize debt repayment over investing in expansion. Paul, we are living in uncertain times, even as we are witnessing the surging US national debt and the unfortunate Israel-Palestine conflict. As an experienced Treasury advisor, Paul, I would like to know from you if you concur with Ray Dalio's remarks about the spiraling US national debt that he says is likely to spark a debt crisis and lead to a meaningful slowing of the economy.
You know, I do agree with Ray's comments for the most part. I would say it's not a certainty, it's a risk though. And it's definitely a high risk, given potential government shutdowns coming again here in mid-November, trying to select a new Speaker of the House as first time in U.S. Speaker of the House was voted out of office, or in that capacity, probably a better way to say it. So I think the realization that we have a problem here and we need to address it. And my problem has been is that, you can just look at this chart that you have in here on U.S. national debt, and you can look at what's happened from the Great Recession to today. That's a rather short period of time where it's more than doubled. That's concerning to me. And what we've historically done is we've been kicking the can down the road, is what I like to call it, and not addressing the real issues and problems. There is a limit to spending. And we can't continue to borrow to feed all the needs that the federal government is out there supporting. There has to be some kind of limit. We're not willing to address that. At some point, you have to do that. You can't cut taxes and spend more and expect that things are going to get better. You're going to end up borrowing more. That's what we've been doing. So I do think there is a risk out there that there could be a debt crisis. it's real, in my opinion. I think Ray is right about that. It's a real possible risk. It's something we can't ignore. Total debt to GDP at 120%, as this article points out, that's pretty significant. The amount is pretty significant. The amount of interest we have to pay with the rising rates, the amount of interest that we're paying has increased significantly. So you can't ignore it. The other point that Ray is making really ties back to what the Fed's been doing, which is to try to slow the economy down. There will be an impact. There already has been an impact on companies' balance sheets. We're seeing an increase or an uptick in bankruptcies out there. This puts pressure on the ability of small and emerging companies within the U.S. to have access capital. If they are able to access it, it's going to cost them a lot more. So it's putting the pressure on the economy to slow it down. And so it's doing exactly what it's supposed to do. And so, again, Ray's comments are reasonable. I think the U.S. has had too long a period of what people like to call free money out there. The interest rates have been so low, and they've taken advantage of bolstering their balance sheets with cheap debt. The reality is that it created a problem as soon as interest rates started rising. The effect on people's cash flows became rather significant as rates started to rise. And so instead of having debt on the balance sheet at 5% and interest rates rise 3%, they were having debt on the balance sheet at half that and interest rates rise. I'm just using this as an example, but interest rates rise by 3%. They more than doubled their interest costs for anything that's floating rate or that they put onto the balance sheet to refinance anything that's matured. So there's been a hit not only to the U.S. government, but to U.S. companies. And so it's a real impact. It's something that we collectively, as a people in the U.S., really need to get a solid response out of our government, how they're going to manage this, because we can't continue to do this. I've told people, for lack of a better term, and there might be some people that disagree with me, we got to stop the insanity, meaning we can't continue to just say, well, we're going to fund the government for another 6 months. We're going to fund the government for another 10 months, a year, whatever that is, and then keep on doing what we've been doing, but not address the issue. And we've been ignoring it for too long. I think we need to sit down and really have conversations around this and do something. Not just talk, but actually do something about it. Have a plan and execute on it.
I couldn't agree more with what Paul just said there. Having some more long-term thinking in what's happening here, because the debt number is eye-wateringly high, and that point is such a good one about the interest rates and what that means to it as well. I suppose for treasurers, it's time to start scenario planning about what a debt crisis could end up looking like for them and their cash flow. If the main outcome is perhaps recession in the US and dragging other economies with US exposure into recession too, that would probably look somewhat similar to other global recessions we've had in the past. So there's lessons that can be learned from those to kind of implement into Treasury strategy looking forward. If the impact of a debt crisis would be a sharp drop in the value of the US dollar, things like import prices could shoot up, inflation might well perk up again too. That could trigger a widespread sell-off of US treasuries by investors. And you can see the dominoes start falling, then that could impact global access to liquid capital. Following that could have a knock-on effect on the bank stability situation. So that could trigger the Fed to have to think of emergency measures to prop up a banking system in that scenario. And of course, all of this could just weaken the dollar's standing as the world's reserve currency, opening up an opportunity for other countries that have a vested interest to try and take advantage of that. So there's lots for treasurers to be thinking about, looking forward, particularly, November isn't too far away now. Obviously, things on the FX side to consider, checking dollar exposures, thinking of ways to mitigate risk potentially. Trade would, probably become more costly and less accessible for some if that were to happen. So there's lots to be thinking about. Yeah, like Paul was saying, it would be helpful perhaps if the people that can actually manage this were doing a better job of it. It's kind of what businesses need.
From what I heard from both of you, I thought of three words. One was eloquent. You summarized the issue very eloquently. The other was, this is concerning and we need to get real about it. And the third was that, both your observations were very pointed and cogent. So I hope somebody who is listening to this episode of the podcast, I'm hoping is an important decision maker and implements what both of you have suggested. Moving forward from US national debt, let's shift the conversation to our next topic, which is about lack of visibility remaining the biggest challenge in managing foreign exchange risk. With currency shifts continuing to impact company profits significantly, more than half of respondents to the 2023 inaugural Argentech CFO survey reported that the biggest challenge in managing foreign exchange risk is a lack of visibility against a backdrop of ongoing market volatility. The survey polled over 500 CFOs, treasurers, and financial controllers across the UK, France, Spain, Canada, and Australia from businesses with more than £1 million foreign currency exposure per year on the challenges they face in managing currency risk. You covered this story for CTMfile. From a corporate treasurer's perspective, what are the couple of findings from the Argentech CFO survey that you think they should most focus on to better manage foreign exchange risks?
Thanks, Push. Yeah, like you say, the top number about the visibility is one thing. The survey also found that some crucial measures such as stress testing, FX exposure, is only being undertaken by about 53% of respondents, while less than half, 47%, don't undertake any kind of scenario modeling. So that's a little bit concerning. I think overall, those results underline the importance of mitigating currency risk. There's a lot of plates that treasurers and CFOs are trying to spin right now. There's a lot going on in the world and with their businesses. So perhaps for some, FX risk has lost the top priority status, which is all well and good until something goes wrong and badly impacts the company's financials. With economic changes like the continued higher inflation and potential further interest rate rises on the horizon, treasurers do need to prioritize how to optimize their FX risk management in order to deliver growth that's sustainable and also, protect their company's bottom line. So that should also include things like defining the right hedging strategy for the business, one that's fit for purpose in today's world. Often it would be a question of, do I hedge or do I not hedge? And if I do hedge, what's the number? And I'll just hedge 10% of my exposures. But that's not really going to work in today's world. So there needs to be a little bit more interrogation of what a hedging strategy should look like, specific to the individual business, I would suggest.
When I think about a company that I worked for, their approach to FX, and it was a lot of the business was U.S. based, but, they had liabilities backed by assets or assets that were making investments in local currencies. At least they were starting to. So they had some on the books. And so it was a question of, do they accept the foreign exchange risk or do they hedge? And they do hedge, what's the right instruments? How much do they hedge? Do they do it all? Do they do part of it? Those are a lot of questions to ask internally. There was a lot of debate, went back and forth on it, and it's not clear cut. But I think there is a case to be made for business specific management of how you handle your foreign exchange risk. And there's different rationales as to why you might accept risk in one currency and not in another. So I think when it comes to the ability to have the visibility to your FX risk or your overall FX portfolio, I think an understanding of your business and what you're willing to accept and what you're not willing to accept will help drive how you actually manage that. But having a platform where you can facilitate the effectuation of hedging and managing that risk is going to be super important to treasurers. A lot of them still today, it's just common, are using spreadsheets. We have clients today that are transitioning from spreadsheets to platforms to manage that. And it's just amazing. These are, sophisticated companies, but they've done this for such a long time and they're so used to doing it. They haven't found a reason to change until I think more recently when FX volatility started picking up. COVID really started making people rethink how they manage their foreign currency risk because foreign currency has been moving around all over the place. So it's probably going to continue to do that for a while. So I think organizations got to look at their tech stack, how they manage risk, what they're willing to accept, not accept, and get that visibility to the entire portfolio and utilize those tools and systems out there to manage that risk.
Yeah, and we just mentioned about the potential impact that the US debt crisis might have on the dollar and potential FX markets. So it's not like this volatility is going away anytime soon. So it should be a priority.
Definitely should be a priority.
Should be a priority. Let's move forward to our next topic of discussion, which is about the Basel Committee's report on the 2023 banking turmoil and its pursuit of a series of follow-up initiatives. The Basel Committee on Banking Supervision met on the 4th and the 5th of October in Basel to take stock of recent market developments and risks to the global banking system and to discuss a range of policy and supervisory initiatives. The report states that the March 2023 banking turmoil was the most significant system-wide banking stress since the global financial crisis in terms of its scale and scope. In response, the committee has assessed the causes of the turmoil, the regulatory and supervisory responses, and the initial lessons learned, and pursuing a series of follow-up initiatives. Paul, of the Basel Committee's follow-up initiatives, which one stands out for you as the most important initiative that you think is likely to strengthen the banking or financial system?
I wouldn't say I would pick one over another in terms of what was presented in this article. I talked about, the strength of the supervisory effectiveness or the ability to identify issues. I think both those are important areas of focus and prioritization. The question is, which one will be more effective in the current environment? Liquidity risk, interest rate risk, that's very real today. It's going to continue to be real for many companies, not just US based, but outside the US. It's a real risk across the board. So the ability to stress test your organization and an ability to manage the risks that are in play. I'm not a proponent of manage away all risk. I think that it ends up costing you too much to be truly effective to try to manage away all risk, as that's most likely impossible to really do in real life. And the cost of it's just not really worth it. So it's managing the right risks, the ones that matter, the ones that you can control. There are things you can't control, but there are things you can control. And so being able to identify those and understand those risks and stress testing it with various scenarios, especially in today's environment, I think is going to be really important. The other thing that I think is, more up and coming, we're seeing companies here in the US that are developing or have developed cryptocurrency exposures. And so they're starting to put these types of new digital coins, digital tokens on their balance sheets, and they're utilizing them for different things. And so this is kind of a new aspect for organizations to manage. It's something I think we're still all kind of learning how to effectively manage it. We've seen crypto markets are quite volatile. So it's kind of a new arena for us, but that's, that any time you're going to a new way of exchanging value for goods and services, there are inherent risks associated with that because it is new. And how do you effectively manage that? So, that's an area where digitalization within the arena of Treasury, I think, is forcing Treasury or treasurers to learn new ways of managing risk for these types of currencies that are available out there as they continue to bring them onto their balance sheet. It's exciting times, but there's also a risk that you might not get some of that right. And so we're going to probably be learning some things as this continues to develop.
Absolutely. And on the regulatory point, after a market event, the pendulum of regulation can sometimes swing a bit too far the other way in trying to maybe overcorrect what was happening. And you think back to the banking turmoil of spring 2023, it was largely smaller US banks that were folding. There was one European bank, Credit Suisse, but that was sort of, I suppose, an open secret in Europe that it wasn't very long for this world. It was just which market event would knock it out. So there wasn't the global contagion that we saw in the financial crisis of 2007 and 2008. And in fact, the big banks, the big US banks, were making huge profits kind of out of the turmoil almost. Depositors and investors were kind of fleeing. The flight to quality was real. So that was an interesting thing to sort of ponder. And also, it takes such a long time for regulations to actually come in and impact banks and then by direct relation corporates. So obviously Basel 3.1, as it's being called, that's being implemented at the moment around the world, but slowly. And in the UK, we recently had the announcement that we're going to be delaying the implementation of Basel 3.1 to 6 months to the 1st of July 2025. Now, that's the same implementation date that the US has already, so it's not like necessarily a terrible thing, but it does knock the UK out of lockstep with Europe in that regard. And many banks still have considerable work to complete their Basel 3.1 programs, particularly in building and implementing a risk-weighted asset calculator that's capable of coping with the new requirements for things like standardized credit, market and operational risk-weighted assets. So that's a challenge that banks are dealing with at the moment. And the Basel Committee is talking about putting more on top of that. And we haven't even seen what Basel 3.1 does. So I just think it's something to monitor quite closely in terms of reactions and responses. Basel 3.1 will have an increase to capital requirements again, not much, but some. And if you look at how that has been going ever since the global financial crisis, that could also have a knock-on effect on corporates when it comes to lending and liquidity with their banking partners. So it's, I think banks are being put through the ringer a little bit at the moment, and it's almost like a natural market reaction. What happened earlier in the year, somewhat coming out of COVID, and that really kind of challenged the underlying fundamentals of a lot of institutions.
Yeah, Ben, when I was listening to you talk about this, a couple things that hit my mind. One, Fed Governor Barr has put forth a proposal here in the U.S. to add more reserves on the bank's balance sheets. And, banks and Wall Street are pushing back on that because it has a direct impact on lending. And so when you think about the money supply multiplier, the money supply effect, that definitely has an impact on that. It's going to be an additional impact on the economy to what the Fed's been doing. So if, raising rates. So if the Fed decides to do that, that's going to be a real impact to the U.S. economy on top of the debt constraints that we currently have. There is some concern about that. And I think about, my early days when I was going through the CFA program, And we always, we had a lot of sections in the body of knowledge to talk about free-form markets and the ability of capital markets to manage themselves. Can they manage themselves fully? Are they able to do that? How efficient are they? There's different varying theories out there. And I think when regulators step in, regulators are saying, hey, capital markets, you're not doing your job. You're not being very efficient. We need to fill the gap. I do think capital markets do work, tend to work pretty effective. It's been shown throughout history that capital markets do work. The ability to allow them to do what they're supposed to do, I think, is important. When the Great Recession hit in the U.S., I was not a fan of the bailouts. I was not a proponent of that. They should have let those banks fail. Yeah, would it have hurt? Absolutely. It would have been a big deal. But they should just let them fail. And that's not what we did. So you opened up Pandora's box as soon as we did that. And it created new issues. So I think, regulators sometimes can overcorrect, which I think was your point earlier. They can overcorrect, and it can have detrimental impacts that could potentially be more harmful than allowing free capital markets to do what they do.
Those are great insights, particularly talking about overregulation, Ben and Paul. The fourth topic in today's discussion revolves around virtual cards. A study from Juniper Research has found that the total volume of virtual card transactions will reach 175 billion by 2028, rising from 36 billion in 2023. Growing by a significant 388%, the market will be accelerated by adopting API virtual card issuing platforms. A virtual card uses a randomly generated and generally temporary card number linked to a payment account, which is used to process payments instead of genuine payment details. Virtual cards provide a secure and fast way to distribute funds while effectively managing spending limits. Ben, you wrote this story for CTMfile, and given that virtual cards are regarded among the most versatile working capital options by CFOs and treasurers and are also used to bridge cash flow gaps as they arise, how significant is this development of easy-to-use API platforms that will enable corporations to establish a virtual card program that can be deployed quickly to scale alongside their needs?
Yeah, absolutely. I think that's the kind of the point in a nutshell. The easy availability and easy generation of these virtual cards. I'm glad you explained the basics of what a virtual card does, so I don't have to. But obviously, many corporates are familiar with the virtual cards concept and the potential benefits they offer in the areas of payments, trade, cash management, kind of all over the place, really. As a digital tool, virtual cards can simplify accounts payable by replacing paper and manual processes. It's easier to obtain approvals and things like enhanced data matching, analysis, reconciliation of transactions. That all kind of eliminates manual admin processes. And the visibility, that's always a hot topic. Visibility they can offer to give treasurers more accurate cash flow position at any one time, setting up spending limits, seeing who's spending what as well. So that could be that's an interesting little wrinkle in the features of a virtual card. And of course, quicker payments and reduced collection costs can have a positive impact on working capital of the suppliers of a corporate, which helps strengthen supplier relationships, opening up the options to perhaps negotiate better rates with suppliers. So there's loads of benefits. Security as well. Obviously, you touched upon Push in your introduction. So anything that makes virtual cards easier to get hold of, to generate, to embed into treasury operations, I think is a good thing. And that would speak to why this growth number predicted of 388% in just 5 years is there from the research.
This is just another example of what the trends are out in the markets. When it comes to fintech out there, we are seeing the acceptance and the adoption of APIs. There's still a long ways to go when it comes to APIs, but we're seeing a rapid adoption, which is allowing for these platforms, banking as a service or BaaS, to be created and utilized. And so the ability of companies to have banking services alongside their products and services that they provide in the free market to people, I think it's huge, because they don't have to go to their bank to be able to do this. They can have it created through the fintech options and APIs, which is really cool. I think it allows organizations to be really creative on how they manage their businesses without having to do it directly through a bank. It'll be interesting to see how banks adapt to this over time. I know that the tier 1 banks in the U.S. have been working fast and furious on their API stables, and they have pretty robust API stables, which allows them to participate in this arena. The more regional banks here in the U.S. are starting to engage in API technology as well. I think this will definitely trickle down to the smaller banks eventually, but it might take a little bit longer. But this really changes the dynamics of how businesses think about banking and the services they can offer their customers. So it's pretty cool stuff.
Yeah, it really kind of speaks to the role of the API in the overall digitization of financial services and corporate treasury. And just it's quite a simple bit of technology, but what it enables in terms of the ease of connecting different systems and facilitating that flow of data is really exciting in terms of where that could lead.
Oh, absolutely.
Finally, gentlemen, what is your choice for the biggest or most important story of the past week, and why? For a change, can I ask Ben, can I ask you to do the honors first?
Yeah, sure. I mean, looking at financial news, there was a report today from the IMF that came out, which suggested that the UK faces 5 more years of high interest rates to stem rising prices, and basically suggesting that the UK will have the highest inflation and the slowest growth next year of any G7 economy. So obviously including the US, France, Germany, Canada, Italy, and Japan in that. The UK Treasury Department hit back, saying that recent revisions to UK growth had not been factored into the IMF's report. So we'll see. But it's just another note that perhaps the war on inflation is one that is going to drag on for quite some time and hasn't been wrapped up just yet in some places around the world.
From my perspective, I think the biggest event that's occurred that's definitely going to have an impact is the ouster of the Speaker of the House and our inability to come to reality on our debt issue in the U.S. I hope our leaders don't ignore it. Over the next several weeks, we're going to find out we've got 4 weeks until the temporary stopgap ends, which means either the government's going to shut down or they're going to end up kicking the can down the road. My hope is that it wouldn't be the first time that the government shut down in the U.S. It's happened before. So it's not like we can't survive that. We can. What we can't survive is to continue to do the things we've been doing and expect that we're going to have a better outcome and not the same outcome, which is, hey, we got to make another decision. We got to quickly pass a bill so that we can fund our government, which means issue more debt. We got to stop doing this. I don't think we should be doing that. So my hope is that the U.S. will come to terms with this and really start doing something about it.
Paul, I couldn't agree more. I hope there is some common fiscal prudence sense. A big note of gratitude to both of you, Ben and Paul, for your time and participation, as well as your discerning and informative comments and analysis. We would also like to thank our CTMfile audience for joining us on this edition of the Open Treasury podcast. Please subscribe and look in the show notes for the article links. Thank you so much and have a great week. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.